All right. Hello, my friends. Today we're talking about how often does an appraisal value come in low? If you just joined live earlier, my mic didn't work. So if you're here, let me know if it does. But we're talking about how often does an appraisal come in low. This is one of the biggest fears that buyers have when I'm walking them through the home buying process or the home refinancing process. Because we get to the appraisal piece and people are thinking, what if my home doesn't appraise for the right value? So we're going to talk about how often that happens and some ways that you can fix it if there is an issue. You can hear me, which is awesome. Thanks for letting me know on that first go around. So basically, what is an appraisal? Okay, all an appraisal does is tells the lender how much your home is worth. It's an official way to say your home is worth a certain price. And the reason why a lender requires this is because they don't want to go lend you money like $200,000 if your home is only worth $100,000. Because worst case scenario, you ever get into a foreclosure, the lender needs to go sell the property, and then they can't, or at least not for the amount of money that they lent out. So that's the whole reason appraisals exist. So as far as how often do they happen, I would estimate, there's not really a lot of statistics on how often a short appraisal comes in, but homes normally don't appraise, in my experience, about 1 out of every 20 deals, which to me feels like it's a bit on the low side because a short appraisal isn't the end of the world. It just means we need to renegotiate a contract a little bit. Okay, it doesn't mean the deal is going to be dead. It just means maybe you put in an offer for a $200,000 house, but the appraiser said it's worth 198, which can just make things a little bit annoying because it slows the process down a little bit. So there are two main reasons why an appraisal is going to come in short in the first place. Number one is just based on the market. So a home is appraised based on what it's worth in a market. Okay, so if you're in a super heavy seller's market like we are right now in most of the US, that means that home prices are continuing to rise, and sellers are able to ask a lot for their homes. Right, a house that's normally $200,000 might sell for $225,000. So homes continue to increase, and you have a bidding war because there aren't a lot of homes available, but there are a ton of people who want the same house. So they're offering more and more and more money, which artificially jacks up the value of the home. So sometimes a home short appraises because the market is almost too hot. Just because people are willing to pay $225,000 for a home doesn't mean it's actually worth that in a more stable market. So things like that can happen. Also, you can have market conditions where there aren't what are called comps. So an appraisal is based on comparable values, which basically means an appraiser is going to look at the home they're appraising and normally 3 to 5 other properties that are very similar to find what did they sell for and how can we use that price to justify this price. So they don't just come in and say, yeah, it looks like a $200,000 house. They're going to say these 5 other homes also sold for $200,000. They have the same square footage, same amount of beds, same amount of baths, things like that. The second reason that homes short appraise, and this is what most people think is the issue, is an appraiser is giving a bad value. And this can happen, honestly. You can have appraisers who are maybe inexperienced. You can have appraisers who have a little bit more of an ego than others do. Sometimes appraisers just don't give the value that we're looking for. And, you can fill in the blank for whatever reason you think that is. But sometimes we just get an appraisal that we might not agree with. And the thing that's always difficult about appraisals is it's an appraiser's opinion of the value. So even though the appraiser gets the contract and they can see the price that you're willing to offer for the home, let's say it's $200,000, the appraiser is going to come in with their opinion of what they think it's worth, instead of, maybe what you think it's worth or what we think it's worth as the lender. And it can be really difficult to challenge an appraiser's opinion when they give it in. So normally what happens is they will put in their value for what they think it's worth. And if you think it's worth more, they normally are not going to go back on their decision. There's a little bit of some ego involved with appraisals. So who is an appraisal good for? Honestly, I hate seeing a short appraisal because what ends up happening, when you're going under contract is you have a buyer who says, I agree to this price, a seller says, I agree to this price, and everybody's moving forward and everybody wants to get to the closing table. A short appraisal technically benefits a buyer because the buyer can buy that home for less money, but that's only if the seller agrees to it. So in my mind, an appraisal really isn't good for anybody because it just creates so much friction. And normally what ends up happening most of the time is deals get canceled because a seller is not willing to compromise. Normally sellers have some pretty high ego in the real estate game compared to buyers, and they normally do not like short appraisals, and they don't want to give up any money to help a buyer close on a home. So when you do get a short appraisal, what ends up happening is you kind of have to go back to the drawing board. You're going back with your realtor and renegotiating with the seller on how you're going to fix this. Because there isn't just one remedy to say, oh, okay, so the appraisal came in short, we're just going to go with that value now. What ends up happening is you have to go back with your realtor, renegotiate. Are you changing the purchase price? Are you reducing credits that you're receiving? Is the seller changing how much money they're going to get at the table? You're trying to work on all of that at the same time, which can be super difficult. So you're going through that renegotiation phase and trying to save the contract. Okay, so here are some ways that you can fix these short appraisals. And I have one trick that's in my back pocket that I'll tell you here at the end that's super fun and no one talks about. And I get really excited by it because whenever I tell realtors about this, they think it's super cool. So number one is you can go ahead and ask for reconsideration of value. You can do this. Oh my gosh, this has never worked for me. I've done a few of these. Basically what this is if you're looking to buy a home for $200,000 and the appraiser says it's worth $190,000, you can basically submit a form to the appraiser, and we do this as the lender, where we'll provide additional comps and say, here's where we think it's worth $200,000. And normally it takes the appraiser like a week to get back to us, and they normally never change their value. There's a little bit of some ego involved in there that they normally don't like to change. I've never seen a reconsideration of value work except one time, and the appraiser raised the price by $1,000, which was basically like a slap in the face. It was super weird, and I was upset about it. So normally that doesn't work, but it's an option. Number two is the seller comes down. So if you have a $200,000 purchase price and it gets appraised at $190,000, the seller can reduce the purchase price by 10 grand. So they take a 10 grand cut, which they normally never like to do. On the opposite side, the buyer can bring extra money to the table. So you could bring an extra 10 grand to the table. Now, normally this isn't very doable for people because, 10 grand's a lot of money to bring extra that you weren't expecting, especially if you're doing a minimum down payment. Now, if you were doing something like a 20% down payment, you can squeeze that extra 10 grand into your down payment. So maybe you're putting 10% down and the extra 10% goes towards that remaining amount. The fourth option is you can split the difference. So, in this example, if it was 200,000 and appraised at 190, the seller can come down 5 grand and the buyer can bring an extra 5 grand. It's not, still nobody wants to lose money or pay money to get the deal done, but it's a fair split. You're coming halfway. The seller wants to sell, the buyer wants to buy. You're doing what you can to make it work, and that's an option. The final option here is to get a new appraisal. And people think that this doesn't really exist, and it absolutely does, but it really only works if you're working with a mortgage broker. So here's how this would work. If you have a conventional loan and we have an appraisal, let's do the same example. $200,000 purchase price, it appraises at $190,000. So now we have $190,000 appraised value. We can actually take that loan, flip it to a new lender, and get a new appraisal done and see what that value comes in at. We absolutely can do that as a broker, because as a broker, we work with multiple different lenders. So one lender cannot reorder a new appraisal, right? So if I have a lender, or if I have a loan at lender A and we get a short appraisal, I can't reorder a new appraisal with lender A. But what I can do is I can take the loan, move it from lender A to lender B, and say, lender B, order a new appraisal. And then we can get a new appraisal that way. And technically, you keep going if you wanted to. You could say, didn't work at lender B, so lender C, order a new appraisal. and make it work that way. That would be a little insane if two appraisals happened and you're not getting the value, then maybe it's a fair value. So that really only works with conventional loans. If you're using a government loan, like an FHA loan, a VA loan, or a USDA loan, the appraised value is going to stick with the property for a few months. So for instance, if it's an FHA loan and it appraises at 190, any other buyer in the US, if they come in and want to purchase that home with an FHA loan, they have to use the value of that appraisal for the next 6 months, okay? So, if you have an FHA loan, you can't go take it from one lender to another lender to get a new appraisal done. But what you can do is you can take it from an FHA loan to a conventional loan and get a new appraisal. So there's some weird rules in there, but you absolutely can get a new appraisal. If you're working with a mortgage broker, you can just have your mortgage broker flip lenders and get a new one done. So that's all that I got. We're running about 11 minutes here. If you're on here and have questions, let me know. I can do some question and answer here in a sec. But I do also have a video that I'll add here at the very end where I talk about how a home appraisal works and some of the ins and outs of everything that goes on there. But I'm going to hop over here to see what we have in some of the chat. So Danielle, thank you so much again for letting me know that my audio did not work the first go round. I would have been so disappointed if I recorded this whole thing and there was no audio. Dwayne, thanks so much, man. I really appreciate your compliment there. My goal is to keep putting out as much information as I possibly can about kind of the residential real estate world. Like I said this in the video yesterday, it's, there's so much information out there about real estate, but it can be difficult to sort through and figure out what's the good information, what's the bad information. And what I've noticed is a lot of people on YouTube are in the real estate world are investors. So they're not really realtors. They're not really in the real estate world professionally. They're just investors, which is fantastic, and they know a lot of information, but they're presenting everything from a slightly distorted viewpoint, because basically it's almost like they're reading a bunch of books and then they're telling you about the books. Whereas I'm trying to give you practical examples from the clients that I work with every day and the situations that I run into every day. So want to continue putting out that information. And it's also super, I don't know the right word to use, is terrifying, I guess, to talk with a realtor, to talk with a lender, because you don't know if they're going to be good or bad, if they're going to try to sell you into something. And, realtors and lenders notoriously are kind of pushy. So it's not exciting to talk to them. Yeah, it's my whole goal with, especially with doing some of these lives is, if you guys have questions, drop them in. I'd love to answer them. And then that's a more of a non-threatening way to interact with asking questions that you want to ask that you might not be able to ask somebody else. So Andy, thanks so much for your comment, man. If I want to qualify more loan amount for my income, is it better to use FHA or conventional? Great question. FHA is absolutely the way to go. I would say that with kind of being careful right now, the US market is in such a strange economic place. We're running into really big liquidity problems across our whole economy. And FHA is taking kind of the front of that, that I think we'll see in the next couple months. I'm not sure how strict FHA loans are going to end up being in the next couple months. But as far as the debt to income ratio, that's kind of what you're talking about is, if you can qualify for a higher debt to income ratio, then that means you can get more mortgage put into your debt to income ratio. So FHA loans allow you to go up to 56% of your income as a debt to income ratio. Conventional loans only allow 49%. So to put it in perspective, let me see if I can do this math here. If you made, let's say, $5,000 a month, okay, and I multiplied that by 0.56, then you could have a total monthly debt of $2,800 per month on an FHA loan. So that would be your mortgage payment plus anything like car payments, credit cards, student loans, personal loans, things like that. On a conventional loan, the max you could have would be $2,450. So an FHA loan gives you about another $400 to $500 a month in wiggle room that you can have as an increased mortgage payment, which $400 to $500 a month is probably an additional, I don't know if I can do this math in my head, maybe $80,000 to $100,000 in approval amount. So maybe beforehand you could get approved for a $200,000 mortgage on conventional, but FHA you could get approved for $300,000. So FHA is the way to go there. I would absolutely refinance into a conventional after maybe a couple of years of paying down some equity. Conventional's not going to have as expensive mortgage insurance that FHA does, and it's going to save you some money there. Okay, cool. Well, I'm going to stay here for probably another few minutes. If you guys have questions, let me know. I'm going to stick around and see if I can answer anything. But if not, I'm going to head out of here and probably head outside because it's super nice. All right. Well, I think I am going to end this. Thank you so much for joining me. If you guys have questions or videos you want to talk through, or you want me to talk through in the future, just comment on any of my videos, and I'd love to help you out. Okay, one more question here. You're looking through some pro formas, found a property to win. However, the duplex is a bit overpriced compared with comps. Would it be prudent to change my loan type if I qualify? So the loan type wouldn't change too much. If you can qualify on like a conventional loan, then going to another type of loan really it wouldn't be worth it. With a duplex, the main benefit you're going to have with going like an FHA loan and doing what people call house hacking is that you can do a minimum down payment of 3.5%. If you are using a conventional loan, the minimum is 15% down. So that's a huge difference. So FHA is probably best. Normally what I would suggest with a duplex or any multi-unit is to do FHA, live in one unit, rent out the other ones, do 3.5% down. You're going to get a great rate on it too. And then once you build up some equity in the property, and maybe after a year, you refinance into a conventional loan and then move out of the property, rent out the other unit there. That should give you a pretty solid strategy there. I would be careful, with the overpriced, with it being overpriced. Duplexes, tend to hold their value pretty well because everyone wants a duplex, right? Duplexes are fantastic, and they're super hard to find. So that's probably why the price is high, which is, good that that if you need to sell in the future, the price is going to be there as well. Okay. Well, thanks for joining me. Thanks for sticking around and for your questions. I'm going to make some more videos here in the upcoming week, but I'll talk with you soon. Thanks.